everyone. My name is Jeff Wilson. It must be very close to the top of the market because we were actually feeding you before you came in here. I mean, which worries me immensely. I think we can all cast our mind back, 20 years when we floated our first listed investment company, WAM Capital, and I think we're at History House. And I think the first year there, I thought, look, hey, I think we might have had 10 or 12 people turn up, and we thought, look, we'll go over the top and get donuts. And we had donuts exactly, they were stale. So for nearly 15 years, we didn't give anyone food. And so probably what concerns you all is, A, we're here and the costs, and it concerns us as well. And B, the food we're giving you. We're not only, I know the attendance nearly doubled when we started giving sandwiches for lunch. But what I'm concerned about immensely is the fact that we're actually feeding you before you come in. Now, does that mean what you're going to hear is really bad, or I'm not sure? Or who knows, we may be trying to put you to sleep. But anyway, look, thank you very much for coming. As I said, my name's Jeff Wilson, and I'll give you the first part of the presentation, and we've got an interesting 2 hours. And the reason we're here today is because you allow us to be here. You all own shares in our various listed investment companies, and you own the companies. You allow us to be managers and do what we love doing, and that's managing money in the stock market, which can be challenging at various points in time. And you allow us, me being the chairman of the various entities and the various board members, to be on the board. So look, thank you for that. And we're here to report back to you. And we do this each 6 months, and it's to keep you informed and for you to ask any questions you want of us. So in terms of what a couple of things I'll be covering. Actually, are we going to do the video? Yeah. Now, the people that haven't been here before, the good thing is that's the third time we've used that video and we haven't changed it at all. So we've kept the costs down there, but I promise you in 6 months' time we'll modify it slightly. Just a bit of housekeeping. That's the disclaimer, so if you can read that, then you can't sue us. So where are we in terms of the market? that's a chart of the US bull market. And the interesting thing is, when I woke up this morning, listening to the TV just a little after 4. I must have been excited about coming here today. They were talking about, with the Dow, I think 36% of the S&P, not the Dow stocks, the S&P stocks are already in bear market territory. You know that we have been, I've probably been bearish or nervous for a period of time. And I suppose what concerns me now is that we have seen the top of the bull market. The good thing about bull markets is they tend to go for long periods of time. It's sort of, you're going up in the escalator. The difficult thing about bear markets, it tends to be you're going down in the lift. And they tend to be a bit more painful. We've had a period where we've had quantitative easing, record low interest rates, and so valuations have been pushed to very high levels. QE is over, and early October, quantitative tightening started. So, we are in a different phase. Who knows exactly what the market will do, but we are nervous, and we've increased our cash levels to reflect that. What we try to do is we try to buy undervalued growth companies and buy them when we can see a catalyst that's going to change the valuation. If we can't find them, we'll sit in cash. And depending on the various funds, we've got different various levels of cash, but WAM Capital, our largest, has about a little over 38% cash at the moment, which we've increased over the last month. That's up from 27% the month before. In terms of one of the positives about bear markets is they tend to be quite short. Very painful, but short. And they go for a year and a half. And who knows exactly where we are, but to me, we like to be positioned sort of for the worst and to hope for the best. In the last 12 months, we've been doing various things. We've made a takeover bid for a listed investment company that was trading at a sizable discount to NTA. And that was a very positive move for WAM Capital. Recently, we've talked about the merger of Century Australia. A number of shareholders have been talking about it makes sense if they're both large cap investors to merge WAM Leaders to Century Australia, and both boards were of that view, and it benefits both companies. And more recently, we put a proposal in to become the manager of Blue Sky, the alternate access fund. Now, let's see how that plays out. Just on that, and the code is BAF. Is anyone here a shareholder in BAF? Got a few shareholders. So I'd like you to vote against the EGM to put the other manager in. And then when our EGM comes up to put us in, I'd like you to vote for us. We've put together a really high quality team of alternative asset managers. I would say the best in the country, that assuming we succeed in managing that, then they'll join the group. And I've always been a believer in getting high quality individuals working with you, because then it makes you look good. And see, I stand up here and take all the praise, but it's really the other people you're going to hear from today that do the hard work. I just make the noise and crack a few jokes. And they wheel me out every 6 months. Now, this is, in terms of at Wilson Asset Management, there's 3 main things we believe in. One main thing we believe in, and 3 ways we deliver it to you. What we believe in is about making a difference. And that is incredibly important to us. I don't need this anymore, do I? And it's making a difference in three ways. It's making a difference in terms of performing, with the risk capital you give us. It's making a difference in terms of giving back to the community, and anyone who's staying later on will hear the future generation presentations, which to me is we've been heavily involved in, and as an organisation we focus on giving back to the community. And the third thing is to make a difference for the people that support us. And I mean, there's been a lot of mud being thrown around. Well, I think it's probably from one side, but in terms of why are we advocating for no change to the franking system or the dividend imputation system? The reason why we're advocating is everyone tends to do what's in their own best interests. The impact on myself personally, I've been fortunate in life. I have people would say is a very good sized superannuation fund, a self-managed super fund, and the impact, I sat down with my accountant about a month ago, the impact on me is zero. Because a degree of my income is not franked as well, so one offsets the other. But from a Wilson Asset Management perspective, we've got 80,000 shareholders. We guesstimate that 60,000 of them will be negatively impacted if Labor bring in the policy to stop the franking credit refund. And you all know we're running a petition, and please, if you haven't signed it, sign it. And also, if you can get your friends to sign it, and send us in any stories, real life stories, because they are the ones that inspire us. To me, what will potentially happen with this change in policy it'll significantly devastate the lives of a group of Australians. Now, there's no reason that has to be done. There could be a lot better way and a fairer way to treat this. And that is why we're making a lot of noise about it, and that's why we're standing up for everyone. And please, if you're around at 2 o'clock, just near the escalators, there is today the inquiry, the House of Reps inquiry into the impact that franking credits refunds will have on people's lives starts in Sydney. Tim Wilson is the chair. He's a Liberal senator. And they are having an open mic. And we're taking anyone who doesn't want to stay around for the WAM Capital AGM, which unfortunately I have to, as I'm chair. But the group of WAM people will be out the front there, and they'd like you all to meet out there at 2 o'clock and walk up to the hearing as a group. And if anyone would like to tell their story, it's an open mic for 3 minutes apiece. I was talking to a couple of people that already will be telling their story up there today, and if not, to listen to various other people's stories. In terms of your little man bag here, or handbag, quite large for that, probably. You've got a few things in here. Some of the positive news is the pen price is still 80 cents. Yeah, it hasn't gone up. You would have thought it would have gone down. And you've got the pen. You've got, if anyone's interested in signing the petition, it's there. And you just put it in the envelopes or give it back to the Wilson Asset Management people. And it gives you the details to make a submission. But also, probably the more important thing is in there, you've got your own little placard. So can everyone, who hasn't got a bag? Can you put your hand up? Okay, we need a few bags here, down to the left. Who hasn't got a bag? Okay, bags over there. If you just keep your hand up, we're delivering the bags. Now, what I'd like you to do, and to me it is free speech, so you don't have to. But if you think that the change in the franking credit system isn't fair in terms of how it's being done, then I'd like you to all, if you look in your bags, whoever's got them, and find your little placard. Colonel, you're neutral, are you? Doesn't impact on any of your clients? No? Grab your placards. Have we got them all? Thanks. So we want to find all your placards. Has everyone got their placards? Okay. Now I want everyone, can everyone stand up? Bit of exercise this early in the morning. Okay. So we've got a big placard there. Why don't we hand it down to John, hey? We'll get it at the end. Oh, the Colonel with that one. So, okay, I'll come on, Colonel, up you get. I'll come down with you. There we are. So no, we've got to turn this way. Turn around, Colonel, yeah, turn around. Turn around. There we are. Look up there.
Fantastic models.
Anyway, what about a bit of movement up and down? This could be the... Great, okay. Thank you. Because we want to send a clear message. We want there to be no ambiguity with our message, that this is unfair, how the policy is going to be enacted. It's inequitable. So, I mean, how illogical can you get a policy where if you happen to go on a pension before the 28th of March, you get your franking credits back, but if you just happen to be born a day later, bad luck. So if you go on the pension on the 29th of March, then you don't get your franking credits. I mean, to me, this was knee-jerk policy, illogical and grossly unfair, that people that have spent all their lives, or actually not all their lives because it only came in 01, but a significant, say 17 years of their lives, believing that they can operate under a certain system. And I was down in Melbourne last Friday at the Sohn conference picking a stock. And unfortunately, I picked it, well, not unfortunately, I picked the global stock because it concerned me that what could happen if that policy comes in to capital formation in Australia. Because the illogical part of the policy is that it actually encourages people. This is the bizarre thing is the Labor say, oh, well, self-managed super investors, they've got too much money in Australian shares. Well, if you live in Australia, if all your liabilities are in Australia for the rest of your life, where do you want to invest? In America? I mean, how illogical. You want to invest in Australia. Investing in Australia, what does it do? It reduces the cost of capital for Australian companies. And what else does it do? It encourages Australian companies to invest in Australia. So they pay Australian tax, they employ Australians to look after Australians. Like, to me, that is the logical part of investing. But no, they want to encourage you to invest overseas. And the tough thing is, when you invest overseas, you are taking an additional risk. And to me, it reminds me of, I mean, there's enough grey hair in the room. Do you remember the farmers' loans? The Swiss loans, where interest rates in Australia were 12 and 15%, and you could borrow money in Switzerland at 3%. The only thing they forgot to tell the farmers that if the currency goes against them, they could owe double the amount of money, double the amount of capital. And that's what happened. And it destroyed farmers' lives. So what Labor's saying is, no, don't invest in Australia, invest globally. So take the risk on the currency. Why in your later years of life do you want to take an additional risk? The stories we've had, and we've had 2,000 odd stories sent into us, and they are, I mean, they do make you cry. And the one I talked about at the Sown was a lady who'd worked all her life. She couldn't afford a house. She had a daughter that was anyway, the daughter was handicapped adult. She looked after the daughter. The daughter couldn't work. Her franking credit pays her rent. Her franking credit refund pays her rent for her and her daughter. So under Labor, that's it. It's gone. I mean, how fair is that? If they want to take the money from the rich, take the money from the rich. Don't lie about it. Do what you're going to do. I don't mind paying more tax. I've been very fortunate. The superannuation system, I've always thought this is too good to be true. So have a progressive tax, like the tax system. Anyway, I think it's appalling. Please, if you can go up to the House of Reps presentation this afternoon, go up. Unfortunately, I can't do today, but there's one at DY. They'll be going to all the major cities. There's one at DY next week, which I'll be attending, and we've given our submission. Actually, can we just flip to the next slide? I know I gave it back. There's one more. That's the team, the management team and the investment team. You know us all. Unfortunately, a team member that I've worked with for the last 12 years, Chris Stott, or Stotty as we call him, has decided to smell the roses for a little bit from a work perspective. From an investing. No, actually, I'm not sure from what. From a work perspective, a 4-year-old daughter and a 6-year-old son is going to spend some quality time with them. I mean, 20 years ago, my daughter was 4, and that's when I retired and decided to set up a little funds management business, which has become a bit bigger than I thought. And we've really enjoyed working with Chris. The great thing is we'll continue to work with Chris as a director of WAM Capital and WAM Microcap. But we've got a good team. And now I'll pass over to Chris, who'll take you through the next part of the presentation. Thanks.
Good morning, everybody, and thanks very much for the introduction, Jeff. I'll speak very briefly today, and before I hand it over to the team of lead portfolio managers. As Jeff said, it's been 12 fantastic years, almost a third of my life in this great business with wonderful people that I've thoroughly enjoyed, and will continue to remain involved, not on a day-to-day basis. So being on a couple of the boards, as Jeff said, and also a few of the team members in the investment team have asked me to act as a mentor. So I'll stay in regular contact with a lot of the investment team. The business has certainly come a long way, as Jeff said. It's changed an awful amount, even in my 12 years in the business. Starting when it was around 2006, we had 300 million of funds under management. That's grown tenfold to be over $3 billion today. We've certainly, these events have changed. I think there's probably 800 or 900 people here today. When I first started 12 years ago, we were getting 50 to 100 in Sydney. In fact, one of my favourite investor presentations that we have done was back in 2010. in Adelaide, where we turned up. We'd go to Adelaide every 6 months, like we do with all the other states, the main cities in Australia. Jeff, Matthew and myself turned up for the WAM research presentation, and 3 people turned up. So we had 3 of us and three shareholders, which was fantastic. And today, I think next week in Adelaide, we're expecting over 400 or 500 people. So it just shows you how quickly things change and how much things have grown. In terms of the last 12 years, we've had a fantastic period. I've been privileged enough to manage your money for WAM Capital, WAM Research, WAM Active and WAM Microcap. I think our performance has certainly stacks up quite well. The business has never been in better shape. Performance is strong. We've got share prices trading generally at premiums to NTA. And also we've got a very high quality, high calibre investment team, which I believe will continue to produce superior returns to shareholders over the next decade or 2 to come. So very, very confident and have a lot of faith in the investment team. And you'll hear from a few of those members very, very shortly in the presentation. So what's the plan for me? I've got no plans. I'm going to have a good break, spend some time with my family and my 2 beautiful kids who Jeff talked about earlier, which I'm very, very excited about. I'm a keen golfer, so if anyone wants to have a round of golf, let us know. But I'll be having a good break and having a good think about what's next. But certainly, just before I finish up, firstly, I'd like to personally thank Jeff. Jeff, you've been a tremendous support for me over a long time period, and I've just been incredibly lucky to work with you. And I can't thank you enough for the opportunities that you've given me. So on a personal note, thank you. And finally, to you as shareholders, I can't thank you enough. We're only here, as Jeff said, because of you. We're privileged enough to be managing money on behalf of 80,000 shareholders. And that is a very humbling experience. And so from the bottom of my heart, thank you very much to everybody. And I look forward to continuing to following WAM's progress, albeit from the outside as a board member. So I'll now pass it over, leave it there, and hand it over to Lead Portfolio Manager of WAM Global, Katrina Burns, to take you through the next part of the presentation. Thanks very much.
I think the Fed is making a mistake. They're so tight. I think the Fed has gone crazy. So you could say that, well, that's a lot of safety, actually, and it is a lot of safety, and it gives you a lot of margin. But I think the Fed has gone crazy. Okay, I'll see you in a little while. No, I think it's good. Actually, it's a correction that we've been waiting for a long time. But I really disagree with what the Fed is doing. Okay?
Donald Trump. Now, I'm sure all of you have opinions on Donald Trump, potentially also on his hair and fake tan, but the reality is that what Trump says, tweets, and does in policy actions really does move markets. If we take a look back at the last 6 months and the key things that are moving equity markets, it really has been conjecture over what the Federal Reserve would do going forward, what Trump's next move would be, and trade wars. If I run you through what's going on at the moment in terms of these issues one by one. In the US, clearly the economy is flying. You've seen GDP prints in Q2 of over 4%. You've got strong jobs growth, and you've got unemployment running at 39-year lows at 3.7%. But what's going to happen next is the key question. And really, a key influence on this is going to be what the Federal Reserve does. I was lucky enough to spend time listening to Janet Yellen in September, and the reality is that the Fed is very much on a path of normalising monetary policy. If we take a step back to what happened in the global financial crisis, clearly unprecedented amounts of liquidity were pumped into the financial system to rescue it. And what's happening now, as Jeff pointed out, is that that liquidity is being withdrawn at a rate of $50 billion a month. At the same time, interest rates are going up. And if you look at what's forecast to happen to the end of next year, there may be 5 more rate rises before December next year. Now, what does that mean for equity markets? The reality is that as interest rates go up, obviously the cost of debt that companies pay and the interest they pay goes up. And also, from the perspective of us valuing stocks, the discount rate that you apply goes up, which means that equity market valuations go down. So if we turn to trade wars, now clearly the China-US trade war is really moving markets at the moment, and this isn't a new policy for Trump. I spent time with one of his economic advisors again earlier in the year, and if you look at Peter Navarro, who is one of his key trade advisors, he wrote a book in 2011 named Death by China. They really have a long-held belief that China has been stealing the intellectual property of the United States and their companies, and that the US needs to reassert its place in the world. So this isn't a flyby, a policy that's just come about. This is a long-held belief of Trump and a lot of his key advisors. Now the question is, will his love of the deal, override this key policy, this key belief that intellectual property theft needs to be stopped? Because if his policies, if the trade wars are allowed to continue, we think this will have an enormous effect on global growth going forward. If we run through what should happen going forward, on the 1st of January 2019, tariffs are due to rise from 10% to 25%. Now, we're already seeing global supply chains try to adjust to the 10%, and they're sort of battling through. But we think if they go from 10% to 25%, that will really slow down global growth and will mean those supply chains really do need to adapt and change where things are made. So to us, resolution of trade wars is really important to the global economy as we go forward. If we look at the US and what's been going on, clearly, as I said, global US GDP growth is very strong. And the one thing we haven't seen to this point is inflation. Now, I've just spent 7 weeks in the US, and the team has we've seen over 300 companies in the last couple of months. And the reality is that inflation is starting to pick up. We're seeing it in freight, oil, although October obviously saw the oil price come off 20%, but wages has been the real part that has been missing, wage inflation. And when we speak to companies, they are increasingly complaining that they are having to pay higher wages, and we think wage inflation will start to come through. And that means a key headwind for companies' earnings growth going forward. As wage inflation comes back, and inflation generally in the system, that will reaffirm to the Fed that they're on the right path in terms of raising rates, and eventually economic growth will slow. So that's for us, as I said, trade war resolution is very important, and what the Fed does in terms of the rate of increases in rates going forward will be really important to how the US economy looks going forward and the growth that they keep printing. If I look at valuations, the other thing that's been very interesting in the last few years has just been the concentration of returns. Since 2013, 37% of the S&P 500 returns have been generated from the FANG stocks. So that's Facebook, Apple, Amazon, Netflix, and Google. 5 stocks have been an incredible amount of the returns generated by the US market. If we look from the 1st of January this year to the 30th of June, 99% of the S&P's returns were generated from the information technology sector, and 82% of the returns were from the FANG stocks. Now that's unusual that you get such a high concentration of returns from just a very small number of stocks. And to us, that was not sustainable. And if you look at what's happened since then, the FANG stocks are down over 15% as a group, whereas the MSCI is down only 4%. If we turn now to the UK and Europe, now political uncertainty is the key issue coming out of these two regions. If we look at European global growth, it's progressively been downgraded through this year. We went into the year and everyone was, touting synchronised global growth, and Europe's growth has been progressively revised down. If you look at in Germany, Merkel has said she won't stand she will step down as German Chancellor in 2021, and Macron's popularity is really waning. And these were two key supporters of the European Union. If we turn to Italy, now you've got a populist government in place. They've been trying to pull back from austerity. They've got government debt to GDP running at 140%, and the latest budget they issued does not meet European Union requirements. Sorry. And the other area is obviously the UK in terms of Brexit. Clearly, negotiations are ongoing. May got it through her cabinet, and then she had various ministers resign. March 2019 is when it's due to commence, and yet they're still trying to work out negotiations. So there's a lot of uncertainty there as well. If I turn to Japan, clearly it's been very easy for a long time to discount Japan. They've had low growth, they've got poor demographics. But we think the key area in terms of investing in Japan is that you want to focus on is companies that have improving corporate governance. And the thing that's changing in Japan is that the domestic market is finally waking up to this and forcing a lot of the companies to improve their governance. And these are the kind of companies that we want to invest in. So when we're looking at Japan, they're the companies that we try to find where you can see the change there in governance, because those companies, there's a strong correlation between improving corporate governance and shareholder returns. Now, it's easy to paint a pretty negative picture on the world, but the reality is that yes, there is a lot of uncertainty and volatility in markets, but that doesn't mean you can't find investment ideas. And for us, we're trying to really find, unloved global growth stocks. We have a strong process, and we think that even despite macro uncertainty, if you can find companies that have their own growth profile and can grow in despite the macro, there's some really exciting opportunities still out there. If I run you through WAM Global, now clearly we only launched the fund on the 22nd of June, so we're 5 months in. And we're really about applying the Wilson Asset Management process on a global basis. Our ideal companies are small, mid-cap companies that, as I said, can grow despite a tough macro. And if I look at where we've invested the money, we're still holding a relatively high level of cash, which has been great. As the market's corrected since the beginning of October, we're at 34% cash. And if you look at where the sectors that we're increasingly trying to find ideas, we shifted away from some of the more cyclical businesses to more healthcare, consumer staples names, because we thought there was a lot of valuation headwinds in some of the sectors like tech. I'll run you through a couple of companies here, just to give you a flavour of the kind of businesses we're looking for. Thermo Fisher Scientific would be one. If you're looking for a comparable business in Australia, it would be CSL. Now, CSL is a fantastic company, but it trades on over 30 times. Thermo Fisher trades on 19 times. Now, this is a medical technology company. They make analytical instruments and consumables sold into pharmaceutical lab companies generally across the healthcare sector. Now, this is a business that's grown earnings 15% a year for the last 6 years. It's got a fantastic management team. They're an industry leader in all of their divisions. And for us, we always look for a catalyst. The catalyst in this case is we think they can deliver earnings beats, so earnings greater than what the market expects. And so for us, that's an opportunity that we think looks exciting at this point in the cycle. Another example would be E1, so that's Entertainment One. Now, this is a UK-listed company, but yet its earnings aren't really generated out of the UK. So this company is a film and content business. They own the franchises that if you have kids or grandkids, you may have heard of, Peppa Pig and PJ Masks. Now, and amongst a whole bunch of other IP that's really, we think's got huge potential. We think there's an exciting catalyst coming up in the form of China. Next year is Year of the Pig. So we think Peppa Pig will do extremely well. They can monetize a huge opportunity in China over the coming years. And to us, it's got a high quality management team, very strong IP, and catalysts in the form of earnings beats to come. So they're just a couple of stocks that are part of the WAM Global portfolio. As I said, generally there is a lot of macro uncertainty in the world, but that doesn't mean there aren't opportunities. And our team's working hard to discover exciting opportunities to put in the fund. And despite market volatility, yes, there is a lot at the moment, and we do think that will continue. But that really gives us the opportunity to buy great businesses at even better prices. So thank you for your time. I will now pass over to Matt, who is Lead Portfolio Manager for WAM Leaders.
Thanks, Katrina, and good morning, everybody. So the biggest drivers of the Australian share market, what are they? They're actually credit growth and commodity prices. In fact, these two factors explain over 80% of the earnings growth or the earnings changes in the Australian stock market. So these two factors are incredibly important. So what I'll do now is I'll touch on credit growth, then we'll look at commodity prices, and then we'll wrap it up by trying to work out what is the earnings growth implied using these factors in the Australian stock market. So credit growth, obviously credit growth is the lifeblood of the economy. Higher credit growth, higher demand, more consumption, higher earnings growth. At the moment, credit growth is quite benign, predominantly due to regulatory issues, not macro issues, but regulatory issues. So banks are under a lot of pressure on who they lend to, how much they lend to, and the regulatory oversight has gone up a lot. Also, banks get a lot of their money from the overseas market. So this chart is showing you the cost increases that banks have faced over the past year. You would have seen the banks put up their interest rates. Why did they do this? This is the reason why wholesale funding costs have gone up. This is a function of the Fed putting up rates, but also some other issues that were at play this year. So you can see here it spiked 2 times throughout the year. This increased the cost for the banks and they passed it on to consumers. And that's the reason why rates went up independently of the RBA. National Australia Bank were the only ones that didn't pass on this cost. They decided to wear this cost. What we'll look at here is banks and where they get their funding from. So the banks rely upon the wholesale funding market differently. So this is the funding gap. So this is the amount of deposits they have within their banks and the amount they have to access the wholesale funding markets for. So you can see here, CBA is the best positioned bank. They rely upon the wholesale funding market the least, while ANZ relies upon it the most. So when you look at the banks, you can work out exposures and who's most at risk if interest rates go up. And going off this is clearly ANZ. So it's something to be aware of. Not all the banks are equal. Different banks have different advantages. And the advantage of CBA is their big deposit base. So when wholesale funding costs go up, they don't have to reprice like the other boys. So it's quite an interesting dynamic to watch. You would have seen house prices come off a lot too. This is basically due to the availability of credit. APRA and the Royal Commission have increased the oversight on how much banks can lend out. So what we're seeing now is a house price correction driven by regulatory concerns, not by macro concerns. So I think it will be quite short-lived unless we get a macro event. Because predominantly the drivers of house prices are credit, but also interest rates and other factors like employment. So far, the other two are quite benign still, so it'd be very unlikely, absent a macro event or macro shock, to get a sustained fall in house prices. Labor policy might change that with negative gearing, might see a bit of a shock there, but we'll wait to see how that plays out. When we look across the economy, so the credit growth, like I was saying, is the lifeblood. When you have credit, you pull forward demand. People choose to pull forward demand and consume now. What was seen post the GFC, you had business credit fall off a cliff post the GFC. You can see a tremendous fall there. And credit growth has actually been quite benign for a few years now. So we don't think we're in a credit bubble or as such within the Australian environment. The housing market does have a high degree of debt against it, but this is quite normal for Australia. So we don't think credit growth will be very strong over the next 12 months. And given that, that will be quite a bit of a drag on earnings growth in Australia. The financial index, or the financial sector, makes up around 40% of the Australian stock market. So again, that will have a direct impact, but the indirect impact will be across consumer discretionary stocks and other stocks which rely upon discretionary cash spend. So the other equation to this, we've got credit growth, and now we've got commodity prices. So what are the drivers of commodity prices? Well, there are a few, but we're going to concentrate on China. So China is a great user of commodities. Commodities such as iron ore, they can basically buy about 80% of the seaborne iron ore market. So whatever China doing has a direct impact. So we're looking here at the Shareholder rate, which is the overnight lending rate to the 3-month and 6-month and 9-month lending rates. We've put up a chart here, the 3-month lending rate. So this is the rate the Chinese government set in the Chinese economy. And you can see here, in 2016, they wanted to stimulate the economy. The world was going through a bit of a transition phase. They needed to stimulate the economy, and they lowered the interest rate to stimulate demand. So you can see here, they've done it again. They've gone back to 2016 lows. So all this trade war impact, they've seen it, they've realised the economy is slowing, and now they're lowering their rates to try and get the economy going again. So far, it hasn't been working. There's a bit of a delay between this policy setting and when it actually hits the economy. We're starting to see small signs of it now. So we think China could actually improve. And if they do get a trade deal done with them over the next few months, it'll be tremendously positive for the country because they've already started to stimulate and they'll get an added kicker from the trade relief. So commodity prices we think are okay. They could actually get a kick up if a trade deal gets done. And we think when we analyse Trump, like Katrina was talking about, he loves doing deals. He doesn't even care if they're good deals or bad deals. He just likes doing a deal. Like with the NAFTA agreement with Mexico and Canada, he came out and said, we've done a great deal. Like, you look at the underlying and nothing changed except for the name. There was $30 million difference between the two deals on how they play out. So he's very much about ego and doing deals. And we think to get re-elected, he's highly incentivised to get a deal done. People forget in May of this year, he actually went back to the Senate and said, I've done a trade deal with China. They're going to buy more oil and more soybeans. And he actually got kicked back by the Senate saying, hey, we've got to go after IP, which is what they really want. So trade, he's always willing to do a deal. So we haven't given up hope here. And if we look at the old economy, this index is a proxy for GDP growth. So Premier Lee quite famously said, don't rely upon our GDP figure numbers. They're actually incorrect. He said, what I look at are 3 things. He says electricity usage, the rail freight index, and credit growth. He goes, they give you a better read of the Chinese economy than the actual headline numbers. So this index is, the usefulness is starting to wane a little bit as the Chinese economy moves away to more service orientated. But for us, we use this index to look at the underlying economy and the demand for commodities, which is more reflective of this index. So we'll be watching this quite closely. You can see here, post the stimulus, it had a terrific run up in 2016 and it's been steadily declining. So we think as this declines, China, again, will pull the lever they always go back to, which is fixed asset investment, building more things. So when the Chinese economy slows, that's what they always do. We'll build a few more airports, roads, train systems, subways. That's how they get the economy going. And we think if things get too bad, that's what they'll do again. We're hearing whispers already. My colleague John Ayoub's up in China as we speak for a week, seeing steel mills and some government officials trying to work out if this is real and if China will come back with a more stimulative policy setting. So hopefully we'll have more answers this week for you. But this index, it's just good to watch to see what's happening in China. It gives you a really good read. So the other thing with commodities, we think commodity prices will hold for the time being, basically because companies aren't spending a lot of money developing new sites or additional volume. A lot of money being spent is replacement tonnage. So this is very good. Normally in a big cycle, you get companies, mining companies, wasting money, doing big acquisitions at the top of the cycle. This time, we've had BHP and Rio both handing back money, South32, Fortescue even doing a buyback. So a lot of these companies are handing back money. They're not spending it acquiring companies. So we think this is quite supportive for the sector and quite supportive for commodity prices. So BHP, they're replacing tonnes, and this is a project out of WA. They're spending about $3.4 billion on it, and it will create about 80 million tonnes of additional capacity in the iron ore market. So again, this cycle is all about replacement, and we're liking the way they're handling their capital management situations at the moment. So this is first blast from BHP. So this project is purely replacement tonnage, $3.4 billion and 80 million tonnes of iron ore will be coming from this project. So when we wrap all that together, credit growth and commodity prices, what do we get? We put it through our models and we get around 3.6% earnings growth through the Australian market for the next 12 months. Current market expectations are around 5.5%. So we're a bit below where we think the Australian market will be towards the broker analyst consensus. So in our view, credit growth will be a drag, but the potential here, if commodity prices do go up, if we get a trade deal with China, we quite possibly could beat that 3.6. But 3.6 is quite a okay level of growth, but we expect downgrades to the street over the next 12 months for the Australian stock market. And if we look at the top holdings within WAM Leaders, I'll point out one, QBE, a perennial disappointer, but we think they're at the right point of the cycle now. They're divesting a lot of businesses. The catalyst for us are divestments. Also, as Katrina talked about, the Fed are pushing up rates, and QBE actually benefit from a high interest rate environment. What they do is they get the premiums from us, and then they invest it in the fixed interest book. So as rates go up, they actually earn more. So for a 1% rise in interest rates, it's around $250 million of extra earnings for QBE. So you can see here the leverage is quite dramatic. So that is one business that will benefit from rising interest rates. If we look at another one there, Fortescue. So I talked about Fortescue. The reason why we like this company, again, we think all the stuff with China will play out the way we expect, and it will be positive for Fortescue. But why do we like Fortescue? For many years, they've been selling really low iron ore content grade to China, and they get a big discount for this. So the Brazilians and the BHPs and Rios, they send over to China 62 to 64% iron ore content. Fortescue were around 58, and they were receiving 30-odd% less than BHP and Rio on their iron ore. So BHP knew this, Fortescue knew this, and they extended their mine. They found some new sites, and they're blending a 60% blend now. So they're testing this up in China now in the steel mills. If they get this across the line, we think they can get a price realisation close to BHP and Rio, and this would be potentially 15 to 20% earnings upside for Fortescue. So we think the catalyst here is earnings surprise, and it's very much in a negative momentum pattern Fortescue, and we think it could break out if they get this 60% iron ore grade pushing through the steel mills. All the feedback we got so far is it works fine, and the Chinese buyers are happy to buy it. So we think this is an exciting stock and one to watch over the next few months if they get this away. I'll now hand over to Oscar Oberg, Lead Portfolio Manager. Thank you.
IT spending is at record levels, and most of these companies don't expect that to roll at all. And that's because it's driven by secular growing themes that we've talked about for forever. Internet of Things and cloud, security software. So those are ones they're not cheap, and they haven't pulled back enough in my opinion, but those would be the ones I'd put on my radar.
Morning, everyone. In today's uncertain market, valuations matter. And one sector where we see extreme valuations at the moment is the Australian technology sector. Now, the Australian technology sector largely consists of 4 companies, which we collectively call the WAR Index. Now, WAR isn't the sound that my daughter was making at 3 a.m. last night, but WAR actually stands for 4 companies listed on the ASX called WiseTech, Afterpay, Altium and Appen. And what we've seen with these 4 companies is extreme share price upside, as these companies have resembled the FANG sector over the United States. And as Katrina said earlier, FANG of course stands for Facebook, Apple, Amazon, Netflix and Google. Now what we saw over reporting season in August was quite extraordinary in the sense that these 4 companies saw their share prices increase over 30%. And that was despite a number of these companies actually disappointing expectations. To put that into context, these 4 companies represented 80% of the small industrial index performance for the month of August. It's the high valuation of these companies and other sectors in the market which makes us cautious. And it's the reason why the small industrials index is now trading at a peak that is 13% higher than the prior peak in 2007. So why do we think it's a danger for investors to compare the WAR sector to the FANG sector over the United States? Well, we see 2 reasons behind this. Firstly, the WAR sector is a much smaller addressable market, which means as growth rates slow, you'll see share prices respond much more negatively. The second reason is around pricing. The WAR sector generally has much larger customers, which doesn't allow their businesses to keep increasing prices, whereas the FANG sector has the ability to scale their businesses globally and to continue increasing prices no matter what the economic cycle is. So look, while these companies have come off their highs since August and are now trading below where they were, or around the same mark they were before the August share price increases, we're still very cautious this sector. Valuations are too high, and we think that any slowdown in growth will be met with a vicious decline in the share price. Now, we thought it was a good opportunity today to run through our 2 investment strategies at Wilson Asset Management across our 6 listed investment companies, which is of course our research-driven strategy and our market-driven strategy. Now I'll talk about research now for the next few minutes, and Martin Hickson, lead portfolio manager, will conclude by talking about the market-driven strategy. So focusing on research. Now, for a company to fulfill our research criteria, generally we're looking for 3 things. The first thing we're looking for is a valuation that is less than the growth rate of the company. So in this situation, what we're looking for is a company that's trading on a price earnings multiple of say 10 times, but is growing at 20%. If we find a company like that, then that's a very good investment for us. The second thing we're looking for is management. We want management to have skin in the game, and we're looking at the track record of management and the board. And the third thing we want is an industry leader. We want a company that has market power. Now, if we achieve all these 3 criteria, what we need to invest in the company is what's called a catalyst. And a catalyst is something that will change the market's perception of that company, to take that particular company from trading on a price earnings multiple of 10 times to take it to a price earnings multiple of 15 times. Now, what we're looking for here is an earnings accretive acquisition, we're looking for a divestment or an earnings upgrade, something that changes the perception of that particular company in the market. So as you can see up on the slide, we've got a selection of research companies that we own at the moment across WAM Capital and WAM Microcap. I'm going to talk about 2 today. The first one I'm going to talk about is IPH. Now, IPH became the world's first listed intellectual law property firm when it listed on the market in November 2014. Now, our catalyst to buy IPH actually came from a poor first half result, where the company suffered from a slowdown in trademark and patent applications. Through work that we did, speaking to industry participants, our conclusion was that this slowdown was actually temporary and that IPH would recover well and actually take market share going forward. But most importantly for IPH, the vast majority of their revenue is denominated in US dollars and euros, and this is because this is where the majority of where their customers are from. So obviously, as the Australian dollar declines against these currencies, IPH's earnings will increase. So thankfully, what we saw at the recent full-year result in August was IPH beat earnings expectations, and now with the company's share price increasing, we believe that they're well placed to make earnings accretive acquisitions going forward. And the final company I'll talk before handing over to Martin is Specialty Fashion Group, which is on the right-hand side of the slide. Now, we own Specialty Fashion across WAM Capital and WAM Microcap. Now, Specialty Fashion used to have 5 underperforming brands. 3 of these you'll know, such as Katie's, Miller's and Rivers. And it had one other brand focused in the plus-size women's category called City Chic, which has been a very high-growth and successful brand. Now, what happened in April of this year was that Specialty Fashion sold its 5 underperforming brands to competitor Noni B, which meant Specialty Fashion was left with a balance sheet which had 0 debt and $20 million of cash. Now, believe you me, I'm certainly no expert on women's fashion, that's for sure, but one of the things I do like about Specialty Fashion is that it's got a very strong growth profile. It has 40% of its sales in online, it's been a big beneficiary of Afterpay, and it has 15% of its sales in the United States and Europe, which has grown very strongly for them. So we see a very strong double-digit growth profile for Specialty Fashion. It has an attractive valuation, and given the state of its balance sheet with $20 million of cash and 0 debt, we see it's well placed to make acquisitions or potentially capital management going forward. So now I'd like to pass it over to our lead portfolio manager, Martin Hickson, who'll talk about the market-driven side of Wilson Asset Management. Thank you.
Thank you, Oscar, and good morning, everybody. Today I'm going to talk about 4 things: cash, the market-driven process, the current state of the IPO market, and a few stocks in the market-driven portfolio. So firstly, cash. Cash is king. We've all heard the saying before, but at Wilson Asset Management, cash is a big part of our investment philosophy. It's our default position. We sit in cash and we'll only invest it into the market if we think we can make positive returns from that investment. This means that since inception of each of the funds, we've held quite high levels of cash. Depending on the listed investment company, the cash levels on average have been between 19% and 42%, so very high cash levels. This means that if we go into a bear market and the market falls, we will have cash to deploy when stocks are trading on very cheap valuations, which is what occurred back in 2008 during the GFC. Secondly, the market-driven process. There's actually a number of different strategies that make up the market-driven process that we utilise depending on market conditions. One strategy is buying businesses or companies that are trading at a discount to net tangible assets, and this includes other listed investment companies. When I started at WAM back in 2010, the market-driven portfolio was positioned towards discount to asset plays. At the time, the property trust sector was trading at very large discounts to NTA. They were trading at 50% discounts. And we bought a number of REITs or property trusts at that point in time. Roll forward to today, over the last few years, the property sector or the REIT sector has been trading at premiums to NTAs. So it's a strategy that we haven't utilised as much recently. Another market-driven strategy is trading around events. So trading around reporting season, trading around AGMs, investor days, quarterlies, any short-term catalyst where we think there could be a re-rating in a company's share price. We also participate in takeover arbitrages. This is when we're buying into a company after a takeover bid has been announced, and we're generating a better annualised return than what we'd get on our cash in the bank. We also participate in short selling. This is when we borrow stock and sell it in the anticipation that the share price will fall, and so we can buy back those shares cheaper. It's not a big part of what we do. In my 9 years at WAM, the maximum short position across a number of stocks has been 5 or 6%, so not a big part. We also participate in IPOs and placements where we believe that we can make a stag profit. However, more recently, given the volatility in equity markets, participating in IPOs has been a tough place to make money. We've seen a number of IPOs that have been pulled, including Catch Group, which runs the Catch of the Day website. It was an IPO candidate which was doing the rounds a couple of weeks ago. That IPO has been put on hold till next year, given the weak market conditions at the moment. Viva Leisure, a gyms business that's primarily based in Canberra. Another IPO candidate, their listing was also cancelled. PEXA, a $2 billion property exchange, which was due to be listed 2 or 3 weeks ago. That IPO was pulled, ended up going down the trade sale route. And National Dental Care, a dentistry business, that IPO is also cancelled due to a lack of investor interest. 2 companies that have made it to the ASX boards have been Coronado Coal, whose share price was down 10% on the first day of listing and is now down over 15% since its IPO, and Microcap Pinch Me, which was down 22% on the first day of trading and is now down 48% since listing. So IPOs is not an area of the market where we've been focusing in the last couple of months due to the fact that it's been tough to make returns in that segment. This next slide has 20 of our current holdings in the market-driven portfolio. So these are stocks that we hold across WAM Capital, WAM Microcap, and WAM Active. I might talk to Collins Foods. Collins Foods are a large franchisee business. Primarily, they run KFC restaurants. They've got over 200 KFC restaurants in Australia, the Netherlands, and Germany. KFC, it's a business that's close to my heart. It was my first job when I was 15 years old, working at high school. I worked there for 6 months and quickly determined it wasn't a career path I wanted to be part of in the long term. The catalyst or the reason why we invested in Collins Foods was their Investor Day, which they held in early October. We thought that at that Investor Day, they would be able to talk to the potential rollout of Taco Bell restaurants. At the time, they had one Taco Bell business that was operating in Queensland. We thought that they could communicate to the market about rolling out Taco Bells across Australia. That's what ended up happening, that the company spoke to the fact that they could roll out 50 new Taco Bells across Australia, and that's led to a significant re-rating in the share price of Collins Foods. Another stock I'll talk to is Capilano Honey, which we've held in our microcap fund. It's an example of a takeover arbitrage. We bought shares in Capilano Honey after the private equity bid had been announced. We were getting a 6% annualised return versus the 2.5% that we get on our cash in the bank. And we also believe that given the strategic nature of those assets which Capilano owned, which is the largest honey business in Australia, we thought that there was the potential for a counter bidder. What ended up happening is Bega built up a 13 or 14% stake in Capilano, and that led to the private equity firm that was making the takeover increase their bid from $20.06 to $21. So we ended up making a 20% annualised return from our position in Capilano Honey. I'll now pass over to Kate Thorley, our CEO, to conclude.
Great. Thanks very much, Martin. We regularly receive questions from our investors about their children or investing for grandchildren, and we all know that the share market is a great place to do that for 2 reasons. One, when you're investing for someone young, you've got time, and secondly, it's the benefits of compounding. So we all know if you take your dividends and you reinvest them back in the company through your dividend reinvestment plan, or you just simply buy more shares each time you get that income, that over time that really builds up. And you can see here that if you'd invested in WAM Capital at the IPO with $10,000, that would be worth $150,000 today. Now, I'm certainly not saying go out and buy WAM Capital for your grandchildren. It is trading at a sizable premium, but we are saying that the equity market and the beauty of compounding is something to look at. We're also really big believers in the listed investment company structure. You have heard us talk about this on a number of occasions. These are they're closed pools of capital. So for the investment team you've just heard from, they're only buying and selling shares based on the merits of those companies. They're not worried about whether investors are piling money in at the top of the market, and they're certainly not worried about investors taking their money out at the time of the market when things are falling. They're able to simply buy investments based on their analysis of the company. So we believe that's a huge benefit for investors. And also as they provide you a very diversified portfolio, very transparent in terms of being listed on the ASX. You heard Jeff earlier on today talking about making a difference for our shareholders with the lobbying on the franking issue. We also like to make a difference in terms of the support we continue to give to the two future generation companies. After our presentation today, we'll take a short break, and then Louise Walsh, the CEO, and Jeff and a number of fund managers and charities will be back here at 12:15 to present to you about those two vehicles. And we're very proud about supporting FGX and FGG. This is the very talented Wilson Asset Management team based here in Sydney. A lot of the team are here today, so please make sure you say hello to them. They'd love to answer any of your questions. We are, as I said, all based here in Sydney and love coming to these roadshows and meeting our shareholders. That now concludes the formal part of the presentation. I'm now going to invite the speakers back up on stage for a moderated Q&A session, and then we'll take questions from the floor. Thank you very much.
Bring your own BYO.
BYO chair. Very good.
How long have you been here?
Me, almost 14 years. Oh, 13 and a half.
I was just asking Kate how long she'd been at Wilson Asset Management. Yeah, because time flies while you're having fun. And I remember, I was just thinking before how well you were doing presenting. I remember when it could have been Matthew and I jokingly, we were saying, hey Kate, we're going to make you speak one day at the presentation. And said, no, I'm never going to speak in front of people. I get so scared.
I know, I always swore when I left school I would never present in public. I hated it.
Well done, Kate. You've come a long
way. You guys
way.
make it all very easy. You're very friendly and very forgiving. Okay, Jeff, over to you. You spoke earlier about we're very close to the end of the current bull market. How do we position the portfolios in terms of preserving shareholders' capital when we're entering, these periods?
In terms of how we invest, we'll only buy a stock if we believe we'll make money. So that is the way we invest. So every company in the portfolio, we believe that the share price will be higher at some point in time. If we don't, then it's not in the portfolio. And how we're different to a lot of fund managers. So a lot of fund managers will be sort of always invested in the market. They'll be sort of 95 to 100% invested in the market, where we can dial our cash levels up. And WAM Capital last night was at 38.24% or 25%. Cash, micro was around the same. Leaders, and Matt can talk to that, has had a lot less cash. You've got to remember, if Matt wanted to turn Leaders into cash today, he could be 100% cash, where it would take us a lot longer to sell our positions. So we tend to be a little bit earlier on that. In terms of the market, I was talking before about where are we in this bull market, and we try to, as I mentioned earlier, hope for the plan for the worst and hope for the best. And there are various, we could see another move up in the market. My feeling is, because now we've gone from quantitative easing, so that 30 years of dropping interest rates, which allowed asset inflation, is over. Now we're quantitative tightening, so that will have an impact. And it's really up to us to find the opportunities, and in any type of market, try to make money. There's no doubt with a market that's falling, it's very hard not to lose some money, and particularly when WAM Capital, say, as the largest one, skews to mids and smalls. There's tends to be higher volatility down there. I suppose what you've got to remember is one of the great things about the equity market is when you invest in the equity market, you're actually taking equity market risk. So therefore, you want a reward that is better than cash in the bank. And if you can take a medium-term view, then you do get that reward. And the real question for us is, if we do, say if we are going into a bear market, then the question for us is how quickly can we make that money back? And during the GFC, it took us a little over 2.5 years to make back the money that we lost during the GFC. It actually took the market, I think, close to 7 years if you added dividends to get back there. So, as an investor, the perverse thing is we like markets to be lower, because in theory, everything's on sale. During the GFC, you could buy companies that are trading at discounts to cash, trading at big discounts to NTA. I mean, what we also do know is it'll be different this time, as it's different every time. So what have we had last time? It'll occur differently. How will that occur? Unfortunately, my crystal ball doesn't tell me that.
Very good.
Does that sort of answer the question?
I hope so. I don't know. You guys tell it no.
Yeah.
So what's the current dividend strategy for each of the LICs? Could you just touch on the profits reserves?
The plan is to pay a growing stream of fully franked dividends. Obviously, it's up to the boards, and it really depends. Our ability to pay dividends is how much franking we get, and also, and let me touch on that, because it's probably relevant to what may happen with if there is a change in government. And to me, I just mentioned to a journalist outside, I'm saying, look, what Labor's proposing with franking credits is actually the Achilles heel of Labor's policies. That's what I believe. And to me, the interesting thing is, my observation is, Scott Morrison did a reasonable job at the start. Really, over the last little period, hasn't done a good job, I would say. But the interesting thing is, if you looked in the Fin Review yesterday, the poll was, when Scott Morrison took over, it was 53 Labor, 47 Liberal. Then there were two polls. They were about 55 Labor in the two-party preferred, 45 Liberal. But yesterday's was 52 Labor, 48 Liberal. So it's actually the closest it's been. And this inquiry that's starting today in Sydney, and if you want it, please take your placards. Because I was quoted in the Fin Review saying, look, we'll march in the street. So this is your marching in the street. So please, feel free to take the big ones or the little ones and meet out there at 2 o'clock. Unfortunately, I'm at the AGM, but there'll be WAM staff marching with you. Let's march down there. I don't know where I was going. I've gone off piste. Anyway.
Dividends.
Dividends.
What's that? Oh yeah, we'll get back to the dividends. Yeah, so we can, and I was telling the journalist, I said, all you've got to do is change from a company structure to a trust structure. And that goes. So in the various entities we manage, all it takes is an EGM to change the structure from a company structure to a trust structure. And in terms of how we get our dividends, say with WAM Capital, about a third of our dividends are dividends we get from companies we invest in. The other 2/3 is tax we pay. And if we're in a trust structure, we wouldn't pay that tax. So the actual dividend we could pay out would be higher, but it wouldn't be fully franked. And so it actually, the Labor thinking that that they will raise that $5 billion is actually a mirage, because it's similar to the mining tax. Remember, they watered down mining tax, but even when they came in with the mining tax, Matt, do you remember what the figure they were saying they're going to raise? Was it $1 billion?
I thought it was 4 to 5.
Yeah, I don't know what it finished up. I thought it could have been even watered down to $1 billion or so. Do you know how much they raised in the mining tax? 110 mil. If it was 4 to 5, they raised 110. Why? I mean, do they think we're all stupid? Don't they think we're all going to change our behaviour? And the people that are selling this, like the people that are getting the refunds, they'll go into structures, they'll go into offshore equities, or they'll go into trust structures or people who change their structures like we can. And to me, it's just ludicrous that they think that people are just going to stay there and give them the $5 to $6 billion. And everyone who sells that share, that has that benefited from the franking credit, they will sell it to someone who may be on a higher tax rate that will utilise the franking credit. So it's a zero-sum game. Anyway, some people won't, and they'll pay and they'll miss out on it and say Labor will get that. So it's not going to be the amount. But in terms of our ability to pay dividends, it really depends on the profit reserve, and please keep a close eye on the profit reserve. So WAM Capital has about a year up its sleeve, so we can pay the next dividend and the next. And then Leaders has a year and a bit up its sleeve. Microcap and Wax have about 3 years. And then Active has, I think, a year and a half as well. And Global, of course, has a little bit, but that'll be a board decision. And I'd assume the board will want to start paying a dividend when it can see we can keep paying them. And really, so it really depends on Global's performance.
And just on WAM Global, how will that company generate franking credits? Can you just touch on that briefly?
And how it'll generate franking credits is effectively by paying tax in Australia. So if Labor get in, but once they get in, the Senate has to pass it. So, our focus at the moment is really trying to hit them as hard as we can on what's on their current policy. And Plan B is to focus on the Senate and to block it, to have it blocked in the Senate. But assuming that all goes through, then if Global could turn into a trust, and then it would just pay a high yield and there'd be no tax.
Okay,
but it'll be a low dividend. It really depends on how big the profit reserve will be in terms of Global's ability to pay a yield.
Great, thanks, Jeff. And Katrina, I'll now pass to you. So you mentioned WAM Global listed 5 months ago. Can you talk a bit more about the composition of the portfolio, where the stocks are held?
Yeah, sure. So we've very much at this point got a developed market focus. We basically have nothing in emerging markets. You will have seen the Chinese markets off, depending on which index you're looking at, but off 30%, which, we have not suffered from. The thing that has happened is obviously small mid-caps. If you look at global small mid-caps, 70% of them are off more than 15%. So clearly small mid-caps in any sell-offs tend to get hit harder, but they tend to rally harder out the other side. If I look from a geographic exposures, we've got about 40% in the US, we've got about 12% in Europe, 5% in Japan, 4% in the UK, and then 34% still in cash. And so then a small bounce in a few other smaller geographies. So that's from a geographic perspective. From a sector perspective, as I mentioned earlier, we really quite early on transitioned out of a lot of those more cyclical trade exposed businesses because we thought the trade wars really were going to have effect on those stocks. So we've transitioned to more defensive consumer staples, healthcare names for a lot of our positioning. We still do have some businesses exposed to current US strong growth, but as time goes on and as we think economic growth starts to peter out there, we'll transition there. But still relatively defensively positioned and in developed markets, not emerging markets.
That's great. Thanks, Katrina. And Matt, can you comment on the banks, please?
Sure. Australian banks, obviously we're going through the Royal Commission hearings again currently, so you'll get 2 weeks of apologies again from the CEOs. But our Australian banks buy at the moment, we still think they're very much trading opportunities. Like the regulatory costs are between $150 to $200 million these banks are facing every year as they respond to the Royal Commission. So costs are up high and loan growth is low. So the combination of those two things makes it incredibly hard to have a buy and hold philosophy with Australian banks at the moment. They're getting really interesting though on valuation. If you think the property market will not fall much further from here and you won't get a bad debt cycle, the yield actually looks quite attractive. So some of the banks, I think NAB was yielding around 11% fully franked. So depends if we have franking anymore, but if there's franking around still, they start to look attractive if you think the dividends can hold. And will the dividends hold? If we don't get a property market crash or we don't have a macro cycle or a capital event, they will hold. So it's looking interesting, but for us, we trade in and out of the banks a lot. You'll see them in our NTA every now and then, but they're really short-term trading opportunities. If they get oversold, overbought, we trade around in them. But if I was going to say a buy and hold, I wouldn't be putting money in them at the moment. I think you could get them cheaper, but they're looking interesting. And if I rank them, probably the top pick would be CBA, then NAB, then Westpac ANZ as far as preference goes for various reasons, but that'd be the ranking.
Great. Okay. Thanks, Matt. Now, Oscar, could you touch on the holding we have in Myer?
No worries, Kate. Everyone's probably wondering why. Look, Myer was quite a simple one for us. I think the business has suffered from poor management for a long time, and our view is John King's probably the best CEO this company's seen in probably a decade. He's got a long experience in retail and turning around underperforming businesses such as House of Frasers that he did over in the UK. Story's pretty simple for us. There's a huge head office in Melbourne. I think there's about 1,200 people, I think, from memory that it was. We think they'll take costs out of that. I think at the last I heard, I think it was at 800. You've seen them cancel a number of events such as Myer Fashion Week and Spring Carnival over in Melbourne. So there's a lot of costs to take out of this business. We think they'll reinvest into service, which obviously this business, Myer, needs in a big way. And we also see them closing unprofitable stores and actually consolidating a lot of the floors they have in a shopping mall. Take the number of levels they have from, say, 3 levels to 2 levels, which obviously save money in relation to rent. Now, I think it's fair to say over the last month, the retail environment has gone a lot tougher, particularly with the consumer feeling pressure around housing and petrol prices and so forth. But I think it's worth remembering that the vast majority of the earnings in this business is earned in Christmas. And so we'll be doing a lot of work in understanding, I guess, the product and how the business is tracking into Christmas. But just finally on Myer, I think it gets a lot of press. But just remember, it's a very small position in WAM Capital. I think it's about 0.7% of the fund. So, yeah, I'll leave it at that. And yeah.
Jeff, is there anything you want to add?
Well, And also, obviously Solly's playing his game. And are we still videoing? Are we still live streaming?
Yes.
Yeah.
Okay, no problem. No. I had a coffee with Solly last week in Melbourne on Thursday, and you know, Solly is he is a great retailer. We know that, and like from our perspective, the interesting thing is it's easy to smack them on the head because, as Oscar said, the performance of the various predecessors to John has been very poor. And the catalyst for us buying, we started buying around the current share price. I just checked it a second ago. It was around 40 cents back in July. Was new management, positive earnings surprise, and the share price should re-rate up. And you know, as we do, we buy it with a catalyst. The catalyst's achieved, and then we can sell it and move on. And the interesting thing about the figures, I spoke to John last night, and you know, everything's on track. You know, the sales figures didn't look good, but you wouldn't expect them to look good. And they've been consistent with that message. You know, that was not a surprise. And it was interesting there, the actual profitability, or the lack of profitability, or the loss was less than it was a year ago. So things are improving, and the cash flow was $7 million better. So to me, that is reasonably impressive for someone who's only been there, you know, since June. You know, so to me, I think the levers they're pulling, or he is pulling, and his management team are the right levers. Now, obviously, it'll be interesting to see, you know, how things flow through. But you know, we're happy. We were hoping yesterday, you know, when Joe, you know, wrote his article, you know, I thought it was you know, cracking phrases he used there, particularly his first line. Is, you know, I was hoping they get sold down to 35 cents and we could, you know, pick up some really cheap stock. But unfortunately they didn't. So, you know, to me, the thesis is still there. And as Oscar said, you know, if it doubles, you know, it'll have a very small impact on the portfolio. If John can't deliver and it doesn't deliver, then we'll move on.
That's great. Okay, thanks very much. We'll now take questions from the audience. We've got a number of microphones set up across the room. If you'd like to...
We're not live.